Hello, everyone. Welcome to Startup Go Academy again. Today is going to be lecture 4. Um, so we already had lecture 4. This is like a re-recording because, or you can say just a recording because I forgot to record last time when we had this class with all of the other students. But I wanted to give this out to all of you to get all of the learnings that you can get from this cohort because we're taking online and we're uploading it in our YouTube channel. So to provide that value for all of you guys, I'm recording it. And today I'm only going to be talking with you, the audience who are watching right now. So there won't be any like asking questions, live interactions. So it might feel a little bit boring at the very beginning, but try to understand or like pause or take it to like 1.5x speed, however you like to watch and learn those things, and make sure you take some notes. Because when I learned these things, especially from YC, then their startup school course that was in Stanford, I took notes. I don't have my diary with me, but it's like a thick diary that I always used to have with me and take notes. And that's how all of those things came together. And I condensed those content uh, into these lectures to provide you guys with the key insights and key concepts so that you can get faster towards learning your startup related concepts and also launch your startup. So, okay, let's move forward. So today our lecture is all about fundraising and building investor relationships. So before we move into that topic, we want to have a quick review of lecture 4. And I always suggest everyone, if you're watching this video for the first time ever, please go back to lecture 1 and lecture 2, lecture 3, because these are built like accordingly so that you don't miss any content, because sometimes I give reference to, okay, we talked about this in lecture 2, lecture 3, lecture 1. So it would be better suited for you. So in lecture 4, we talked about pricing, and I gave 5 pricing insights. One of them is keep raising prices until you get pushback. This is a really famous concept from YC as well, that they talk about it a lot of the times, is that your ideal price is when your customers complain, but they still pay. They might talk about a lot of things like, hey, why are you raising prices? This is not, kind of like going with our budget and blah, blah, blah. But still they're paying. That means you have values and you keep raising until at some point you start losing those customers. Then the third one was, what if users won't pay more? Well, you need to build more value into your product. You need to solve a bigger problem. Then you can expect to get paid more. If you are providing the same service, same thing again and again, and you expect them to pay more, realistically, it's not going to happen unless you bring in some new innovations, some new things that can solve more aspects of their problems. And key important thing that you need to keep in mind is pricing isn't permanent. It's dynamic. It changes based on how your company is moving towards the future. Because as a startup, you always have to keep innovating. You have to keep bringing new things, not always the new features, but improve even the existing features that you have. And most importantly, keep it simple. Don't overcomplicate. Don't bring in all of the functions that you think, okay, if I bring in this function, I can charge more and this and that, but maybe those specific functions are not universally usable to your customers. So you'll have to find the pain points and the like top problem that your customers are always talking about and your customers are pointing at, and you build features upon their insights. Then also we talked about the growth strategies, which is doing things that don't scale. This is a really, really famous concept from the early stages of Y Combinator, and a lot of the founders, like, uh, made this as one of their motto, is like doing things that don't scale. And also talked about how to do sales. Sales is really important because if you don't have sales after a certain point, your company is going to run out of money and it's going to die. And then what are the sales funnels, and how much or how should you charge for your product, which is like the business model, um, working backwards from your goal. So if you have a certain goal, work backwards and you will find the specific things that you need to work on. And we also talked about some growth concepts. Now, for today's lecture, firstly, we're going to talk about the fundraising part. Co-founder of YC, famous Paul Graham, famously said that raising money is the second hardest part of starting a startup. And the hardest is making something people want, right? So when you are like, trying to build your startup, don't need to be too concerned about raising funds. Like, uh, so many times founders, even like in our cohort, in cohort one and even in cohort two, students are asking these questions: how do I get money? How do I raise money? How do I, connect with investors? But though all of those things comes at the very later stages. I mean, early stage, later stage. Um, it's not that different. What I mean by that, in your early stage of startup, you should mostly focus on bootstrapping. I'm going to talk about what is bootstrapping later on. Use your own funds. And then later, once you have a functional MVP, and then you can move forward to raising some funds, maybe apply to YC, other VC firms, and then step by step you move forward. But also, even before going to VC, there are lots of other ways how you can get money without giving up equity that I'm gonna discuss today as well. So what is fundraising? It gathers money to fuel our company's operations and growth for external resources. So this is going to be the fuel that is going to, take your growth forward. It's going to help you to grow. Maybe you're going to use this money to, buy some GPUs to train the LLM model. Maybe you're going to use this funds to, have a basic living, or, hiring some really good engineers to your startup in the early stage. That's how this money is used. The money is not used for, at the very beginning, like doing huge marketing campaign. Then also like, you like as a founder, you might think, oh, I need to raise money first because I don't have any skills. If you don't have any skills, don't start a company right away. Like, gather some skills. Once you have an idea, you list down what are the specific skills you might need. You don't have to have all of them, but at least to get started, what are the things that you need to pursue the startup? Because if you want to be the founder, if you want to be the CEO of that company, you need to know some of the stuff. Otherwise, if you hire people, let's say you raise funds, and if you hire people, you will not have any idea of what they're doing. You will not be able to guide them. You will not be able to solve the problems when the whole startup is in a mess, because it's going to be really common for startups to become and be in a mess. So why fundraising? One of the more another important thing about this is that it's an urgent need for your startup expansion to capture market share. So if you want to capture the market, then okay, then what are you gonna do? Probably you're gonna do some sort of marketing, not that big in the initial stage. But fundraising is not only about early stage, but you also have Series A, Series B, Series C. So if you're trying to expand at those stages, then you need to raise funds, and you might need more people power to boost it forward. Also, for first-time entrepreneurs, fundraising is about validating demand. So if you somehow raise funds, that kind of shows that, okay, you have some sort of demand in the market. But shares are most valuable assets for a company. Keep in mind, a lot of the founders make this mistake that they gives away a lot of equity in earlier stages of their startup, trying to get more and more funds instead of doing innovation, instead of building product. Because once you have a really good product, fundraising is just a complementary thing. It's going to come in your way. The VC firms, the angel investors, they're going to find you have a good product and people really need it. But if you don't really have that one and you need to go and beg to like, hey, invest in us, they're going to take the most equity as possible from your startup. And you wouldn't have a negotiation point because you don't have that base to talk about. So the conclusion is fundraising is the last result. Don't take it as an obstacle for your startups, like, hey, I don't have any funds, so I can't do startup. No, especially I talk about it a lot of the times is that nowadays with all the AI technologies and everything, you can use ChatGPT, Perplexity, Gemini for free. That works awesome. And then you can have a really good team. And if you don't have a team, you can go to co-match, which the startup that I'm building, you can find your partners there, and once you see some matches, then you can maybe pay the subscription and then get to meet with your co-founders. And then also inside the platform, you'll be able to get other tools to help you move forward with the launch of your startup. And then after doing all of those things comes the fundraising part. So this is the last result. Once you have a product, an MVP, then and you have some initial customers, people have need, demand, you move forward with that. So some challenges that you can find in this scope of like fundraising is that investor scrutiny. Investors evaluate startups like customers do products. So when you're going in the shop and you're trying to see, okay, which one is better, which one is a better deal, it's the same because you're always preferring potential successes over failures. When you have two different options, you will choose the one that shows like high quality and sometimes like organic or something. So startups, like investors also value it in that way. So if you're going into that specific part of your startup where you're raising funds, make sure you have a product that is way better than your competitors, and you have some amazing group of customers who are, kind of your fan. Then you have an edge to convincing investor to choose you and invest and give more and more funds to your startup. Then another one is market dynamics. So limited investors and their unpredictable actions can greatly affect startups. This adds uncertainty to fundraising. So as I mentioned previously, be cautious about that because this whole game of fundraising is kind of like unpredictable. And a lot of the times you will meet with some greedy investors. Me, myself, when like I was focusing on raising funds, like we have some initial MVP. Now I went out and then tried to raise some funds. I was offered a little bit of money, but in exchange of 40% of equity of our startup, which is crazy. So just be aware of those things. Don't fall into the trap. Just focus on your startup, build, and once you have a good thing, it's gonna come to you sooner or later. The essence of fundraising is you exchange equity for capital. So investors are not going to give you money for free. Like, hey, I give you the money, just do whatever you want. You'll have to give a part of your company, as I mentioned previously, is that keep the shares or the equity of your company intact as much as possible. How do you do that? Again, through innovation, having a great product, you can keep much equity for the next rounds of your startup because early stage Series A is not the end of raising funds. You have Series B, Series C, Series E, even sometimes Series G, H. It varies from companies to companies and which market are you in. But most of the companies, if you're planning to go towards like IPO and something, maybe Series C, Series D, you'll go towards that path. Then you might ask, where is this money coming from? Investors are giving you money and stuff. We all want to raise money because we feel like this is like free money. But where is this coming from? First of all, in the earlier stage, as I mentioned previously, you're going to do bootstrapping. So this is the round where there's no like kind of like official third party involved. What I mean by investor is like you, your family, friends, and there's a thing called 3F, which is friend, family, fools. These are the people from where you can get the initial funds. You don't have to give up equity because they're family, friends. And the amount ranges from maybe $1,000 to 100K, depends on how much you can get from there. Um, so this is the stage where your idea is in the ideation stage, and you need some initial fuel to move you forward and build a functional MVP. Even though nowadays with AI you can do it with just your pocket money. Then later stage is seed round. Here there's like individual angels or incubator accelerators. Like for example, YC comes into this part where they will probably invest in you like $500,000 if you have a good product or if you're a good founder. And then like here in this stage, you probably have like a demo or MVP. Even though YC says that they invest in ideas, they used to do a lot, but nowadays the startup industry is becoming so competitive is that just by seeing a PowerPoint, it's not really convincing to invest in them unless you have been a founder before, you have built a company before, or you have worked in this big tech or OpenAI researcher. You have this huge following. Somehow you can gather the customers and somehow you can build something out of that, or maybe you'll pivot and have a really good product at some point. But if you're a first-time founder, um, think about having a demo MVP, even some initial customers, paying customers before applying to YC or these incubators. You'll have a higher chance of getting into it. Then it's like angel round. There's like angel investors, different investment organizations. Here is like the Series A where you usually raise between 1 to 10 million. Or sometimes it can be more. It varies depending on startups. Um, I mean, there's angel round and Series A round, but it kind of like overlaps as I mentioned, as that in Series A or angel round you can raise between 1 to 100 million, but uh, there can be key differences that in the angel round you have like a functional solution, you have some customers, but in Series A it's like you have a product market fit. And it's a really important thing. You'll hear this term a lot, product market fit, PMF. Once you get that, you're set for growth. Now is your target to grow your startup as much as possible. And after you have that PMF, the next round of raising funds gets easier. Then you have Series B, where like big VCs, private equities, co-investments, they comes together. You will see a lot of times the lot of posts like this investment round was led by A16G and then followed by others, like that happens a lot. And then Series C, Series A, Series B is like where you have a mature business model and you can raise even like maybe $1 billion plus. So this is how the money comes into your startup. And in terms of like, if you ask me where these angel investors get money, it's their own money. That's why they're called angel investors. But for VC or private equity, these are money from their limited partners. Uh, then also sometimes maybe US university endowments, national funds, then some prominent individuals will donate or not donate. It's like they're gonna give their money to manage in these VCs. Like something like there are a lot of different things based on different countries, different places, how these VCs or private equity firms gets money. But I think this one I mentioned already. Bootstrapping is your own, then equity financing, which is like your family, friends, roles, and you can also, the other key thing here I want to mention is that in this bootstrapping round, in the pre-seed round, you can also join different competitions. In some universities, they have a lot of the time some entrepreneurial competitions where you can join, you can get some initial funds. It varies from like $1,000 to $10,000. Sometimes you can join hackathons, or you can apply for government grants. A lot of the governments around the world are really generous, and then they want more and more startup in their region. You can also do crowdfunding through like microconnect, but you can also take a loan, but I wouldn't suggest taking a loan, especially in the initial stage of startup, because you don't have a validated product. So if it doesn't work out, you might be in debt. If you're afraid of debt, then it's not for you, and also it's not suggested, because there are a lot of other ways to get funds as well. And I think I mentioned about the three F's. But one thing that you need to keep in mind when you are trying to get money from your family or friends is that it's a personal relationship. And so personal relationship and business can kind of create complexities, especially when you are involving non-accredited investors. So if you say that, hey, if you invest in us and then we're gonna give you some equity or part of the company, like don't just say it in a way. If you feel like for the money that you're getting from relatives, you will have to give some equity, just have a proper paper contract, even if they're friends or family. Otherwise, let's say once your business works out really well, then they're going to come like, hey, I want this percent of equity. You took this amount of money and this is worth this much right now. So just get into those troubles. There has been a lot of examples. If you search in the internet, you'll find some of them. But yeah, if you look into, I think on one example, which is like convenient funding, Amazon was started by Jeff Bezos through his mom's $250,000 initial investment that she gave to him, and then that's how it moved forward. So as I was talking about like the seed capital and how the angel investor thing works. So in the seed capital, it moves your startups from idea to market, and also some extra resources that you can get through this round is that you get connections with investors, some fellow entrepreneurs, some other companies that maybe you can build partnerships with to make your product better. You can get mentorship, guidance, and also you can get deep engagement, which is tailored. You get hands-on support for startups. And how this VC investment timeline works is that, at first you have a reset business plan, then arrange internal meetings with the founder. Usually like the investor arranges like internal meeting with founders, multiple meetings, then they will show different investment intentions. Then after they make some kind of decision, then they will issue term sheet. This is like what is termed as like list of investment terms, like this is what you can do, this is what you can't do, and this is how long it's going to be, and like bunch of, it's kind of like the rule book for that investment. So really when you get the term sheet for any time, read it very carefully so that there's no hidden things there which can cause damage to your startup later down the line, because this happened a lot of times. There has been a lot of lawsuits for this kind of shortcomings. Then also, then the investor will conduct due diligence, maybe some also like financial due diligence. Then second investment committee meeting, get final approval, sign share purchase agreement, which is SPA, or SHA, which is shareholders agreement, and then the investor will share funds and to the company, which is your startup. So this is how long it might take for a startup in China and for a startup in the US, which are the top two economies in the world. So in China, the seed or angel round takes from between 1 to 4 months. Series A is 6 to 12 months. Series B 9 to 18 months. In the US, it's like seed round is in 2 months. Series A 6 to 12, and Series B 9 to 18. So in China, it's hard to get started in the initial stage, like raising funds in the seed capital or angel round. That's why a lot of the times you would even see that some of the Chinese startups, they need to give up more equity. But in the US, it's usually, if you look at the ideal like YC style, which is like 7%, that is not a lot in terms of, or in exchange of what you are getting from YC. You're not just getting that 500K, you're also getting a lot of resources and also mentorship, guidance, and future opportunities to raise your Series A, Series B. So this is kind of like might seem like complicated, which is kind of like the structure of the VC firm or investment. If you don't want to like know more about it, you don't have to concern about it a lot, because it's, I mean, I don't think it's gonna help a lot, but in terms of you building the startup, but um, if you know it, it can sometimes help because you know what works in which way. So usually a VC fund structure, how it works is that they're like general partners, which is like the investment team. It's like they does profit sharing. There's like carry, typically 20% to 25%, and then also there's like management fee. Like they will have to give management fees to these VCs, who are gonna use this fund to hire employees and do really operational stuff. There's like limited partners. They also shares profit, but it's typically 75% to 80%. So limited partners are, typically like the ones who get the most out of the investments, because they're investing the money. For general partners, they're usually like managing it and like carrying it over. So a lot of the times why this investment takes place is because people who are at the frontier of technology or innovation, they have a FOMO, which is a fear of missing out. Uh, like the companies like OpenAI, it didn't really come out, it didn't really became famous overnight. I mean, it became famous overnight, but it was not really one day, like, hey, they just started weeks ago and then they became really popular. No, they have been building, I think, since 2016, like for 8 years. Wow. And then at some point they had a good product, and then people started knowing about them. Before that, investors sometimes were like skeptical or something, but still they kept going, and then they raised funds here and there, and now they're a big company, and now everyone wants to invest in OpenAI. So it's kind of like that. Most of the time, you as a founder will have to create that FOMO if you want to get good funding. That's why innovation is so important. Because if you're not creating something of value that you can show to investors, like, okay, this is a huge market. If they don't invest right now, then someone else will catch it. And this one investment can be a life-changing decision in their life. I mean, in investors' portfolio, most of the times over 50% of the startups or investment doesn't work out, or sometimes even 90%. That mere 1, 2%, or 5%, or even at most 10% of the startups that really goes out in the market, disrupts the market, gets the IPO, those are the best return on investment, and the investor gets most out of them, and then they can take out that money and invest in the future startups. So you'll have to show them or convince them that you are going to be one of those companies that is gonna be that one of the billion-dollar companies or a unicorn or the go to IPO. So some financial metrics that you can look into is the IRR, which is like high IRR means efficient capital use and strong risk adjusted returns. DPI shows LPs have recouped or exceeded their capital, reflecting actual cash flow performance. And usually there's always an exit mechanism for these VCs who are investing in you. Like it typically includes IPO, like your company goes public, or your company is being acquired by some big companies in that industry, maybe like Google, Meta, OpenAI, or private share sales, like you share some private shares to some other companies or individuals. So the choice of exit strategy directly impacts the realization of the IRR or DPI. So before I move into delusion, I would ask you guys to think about, have you ever watched the movie The Social Network? It's the story of Facebook, how it was born, and how there was like a big lawsuit against Mark Zuckerberg by his co-founder uh, Severin. So this this is a really typical example where they had a problems with delusion. Some delivered more, some didn't deliver, and all this stuff. Um, but talking about that founder conflict, here I want to talk a little bit again about co-match. So my purpose of building co-match for all of you out there who's currently watching, maybe I don't know when you're watching, now it's 2025, maybe you're watching further down the line a few years later as well. But the main purpose of building co-match for me was to like look at this different examples and people's frustration who wants to do startup but not being able to find that right partner that can go along with them, that knows this stuff, that can have some sort of skills and also somehow matches values. How do you make friends? You just uh, go over to some people, you have classes, you do this thing together or that thing together, you find some common things, and then you become friends. But what if you don't have to go through all of those things? You already can list those common things, those values, what matters to you and stuff uh, to a platform, and it helps you to match with those pool of people. And still, you have the chance to, after some time spending with them, you feel like, no, this is not what I expected, or this is not what I want my co-founder to be. You go move forward, you find the next person. So I think this can revolutionize this whole problem of like startups failing because of this co-founder conflicts. Even though co-match is initially for finding co-founders, but then later on you will have all the other tools to build your startup. Especially it was specially built for startup founders, especially early stage startup founders, from taking them to finding a co-founder to launching and maybe in the third stage also raising funds. So coming back to delusion is, let me tell you what is dilution is. So equity dilution is defined as a decrease in equity ownership for existing shareholders that occurs when a company issues new shares. Typically, a founder starts out owning 100% of the company, and then every time capital is raised or shares are issued, the ownership stake is reduced. Even though here it says like 100%, but when you have co-founders and you're starting together, this varies. Sometimes maybe um, equal split 50-50, 60-40, 70-30, like that. I think, one of our previous lecture, I mentioned that the difference between equity splits in China and the US, in China, the founder usually keeps around like 90%, and because I think the VC wants to see them having 90%. And in the US, it's like equally, and it's like more generous of like co-founder sharing same sort of or close to same sort of equity. So yeah. So just what dilution in simple term is that when you're going to raise more funds, if you have like, let's say 70% of your company's shares, is going to go down to maybe 67%, 65%, because you're now creating those shares to give to these new investors. So here's a simple chart. I'm not going to go into details, but you can see how the total value and like the pre-valuation investment works in terms of like, giving more shares. Let's say if you give 1,000 shares, when you have 1,000 shares, you have 100% equity. Then you have created 1,500 more shares. Now you are diluted to 66.67%, and the 50%, 14%, 34%. It goes like that. You can do some analysis or take some time in it, but I'm not gonna go into it because this lecture is getting already long. There's convertible notes. No, convertible bonds, debt that can turn into equity. There's like interest plus potential. You can earn regular interest with stock gains. And also there's like balance risk. It's like safer than stocks with upside via conversion. So now we're going to talk about SAFE. This is one of the most important thing for a startup in the earlier stage. What is SAFE? So it's a contract that outlines the terms of the investment. So a SAFE agreement is a funding tool for startups with 3 key points. It lets investors turn their money into company shares later. There's like a valuation cap. It caps the price for turning money into shares, protecting early investors. That's why it's really popular for YC and that does that, because it protects their shares in the early stage. Then there's anti-dilution. It keeps investor shares from being reduced in future funding rounds. So you can think about that SAFE is like a deposit. Imagine you go to a store to buy a pair of sneakers, which will increase its price in the future. And the store owner asks you to pay a $10 deposit now. You will only need to pay a maximum of $100 when you buy the sneakers later, even if the price has risen to $200 by then. No. So I think the YC, when they gives funding, I think $125,000 is like direct. Another like $375,000 is through this process of like, you when you raise the next round of funds, they keep their equity intact, so that when you're raising a lot of money, the share doesn't go down too much. Um, and for bootstrapping, I think I'm kind of like repeating because it's important. Bootstrap if you can. Your equity is most valuable asset. And as a student lacking funds, you'll need finances to validate ideas. But also, if you, as I mentioned, if you try to raise funds early on, it will bring responsibility and initial support. But it, kind of formalizes your operations and increases your efficiency. Um, there's also a case for this for Airbnb. When they were in the early stage, how the bootstrap is like they sold themed cereal, and the money that they got from there, they put it back into building Airbnb. So they got like around $30,000 from cereal sales online and at events. So if you're in the stage where you don't have enough money left, like some sort of funds, try to do a side business. Me myself, I've been doing a bunch of gigs and stuff. Sometimes I do it secretly on campus because sometimes on campus we are mostly required to focus on studies, and as an international student you are not supposed to you know have different sort of income because you're capped at some your working hours. Like this is how many hours you can work, this is how much money you can earn, and all this stuff. So but still, uh to be able to put the money in your startup you need to have some sort of gigs. Uh, then I talked about government grants. It's like non-payable. You don't have to pay them back. You don't have to give them an equity. But sometimes it can have strict guidelines. So please read the detailed application requirements, and based on that, you just move forward with it. Mm. Mm, some of the examples of government grants in the US are like SBIR, which is a Small Business Innovation Research Program, then SCTR, which is Small Business Technology Transfer Program. And the way these funds work is like in phase one, they will probably give you around $50,000 to 150K um, from, from the earlier stage, from 6 months to 1 year. Then phase two for 24 months, 500,000 to 1.5 million. So, and then the phase three is like mainly commercialization. And in China, this is what I discussed with our students because they were mostly from China. Is that there are a lot of government funds, especially China, is like really trying. Their government is trying to move their innovation forward and give a lot of opportunities for founders. So in Nanjing, Suzhou, Wuxi, Ningbo, they have this municipal level funding. Sometimes it ranges from 1 million to 5 million RMB, and they have like this like around in this year you're gonna get this much, this year you're gonna get this much, but also there are a lot of regulations. Sometimes it might also involve state ownership if you're not a big fan of state ownership. um, this fund might not be for you, and also they require you to go to specific cities. So if you only establish your company in Suzhou, then only you can have access. Sorry. Then only you can have access to these funds. Um, and there are a bunch of competitions. This is one of the competition in China, high cool, thing called presidential award. But even though they say they give a lot of money, but it's mainly, I feel like for me, I participated in them. It's kind of gimmicky. Like they already select um, who's gonna be the winner, but they still get all those applications, and I think maybe to show the government or like to show the prestige of that their competition. But so just look into it. I'm not saying that all of the competitions is like that. I think in the US is more valid. You know, you can go through it every year, um, knowing that there won't be corruption. But sometimes in other parts of the world, even sometimes back in my country, the corruption might happen. So just be cautious of that. I mean, you're not losing anything, but you might waste some time on that. And you might have high hopes, even though you have a really great idea, but they might fund some government related companies. But in the US, there are like some good competitions. Like for example, MIT, they have like a 100K grant. So it's like for pitch, you have 5K or 2K. The accelerator, you have 10K, and then for launch, you have 100K. You have like the Hello Tomorrow Global Challenge Prize. So in the final, as finalists, you can raise around 150K pounds. So, or yeah. Mm, I'm just gonna take a short sip of water because it's been I don't know why I'm not being able to talk that clearly today. Okay, it's different when I have the students in front of me. We can interact, ask questions, and just take a breath. But uh, doing like a 2 hour lecture directly, it's kind of tiring. But anyways, I'm gonna do it for all of you so that you get the value and you can move forward with the learnings. So crowdfunding. Crowdfunding often doesn't yield high profits. It's mainly for hype. In China, you need to raise over $1 million through crowdfunding to get investor attention. So it's like a promotional tool, not like a long-term sales strategy. But you can validate the demand whether people really needs it or not. So Microconnect. So Microconnect is a financial technology company that connects global capital with China's thriving small and micro enterprises. It helps small and micro businesses achieve annual profits of over 1 million RMB to like 7.4 billion RMB. So, and there's also like revenue sharing, invest directly in daily operations and get tailored support. Yeah, so a bunch of this stuff. Now, now you know the concepts. Uh, what are the things to do? What is this? What is that? Now you're going to prepare for fundraising, right? Before you prepare fundraising, know your vertebra. Know your vertebra, which is what do we do? This is the what. You have what, why, how, why as, why now. These are the bone core of your startup. So you can take a screenshot of this page. This is a really, really important page. So in terms of what do we do, you need to have like a 2 sentence elevator pitch of like that clearly states that clearly states what your company does. Don't use a lot of buzzwords, AI, large language model, neural network, machine learning. No, say it in a way that even like 5 or 10 year will understand that what problem are you solving. If you can make it that simple, people will understand and know your company better, and they're going to remember your company better. And then your company name, what it does. As I mentioned, don't set up the problem too much. Just get to the point. Don't need to say according to this data, that data, this and that. I mean, you can go on all day talking about the problems, but just focus on one or two key of the problems and then directly get to the point. Talk mostly about the what solution you're bringing in. Then why? How big is the market, right? The market size and the percentage you can own, and if the customers want your products and how much you could charge. And this is where comes the business model, how much you can charge. Just have like a simple business model. Maybe it can be subscription, it can be marketplace, like SaaS, B2B. Just have a simple business model. Then also, mistake startups often make is offering a potpourri of business models, which is mixed up. We also have this part, that part, this and that. It's like a mix of, no, don't go in that route. Keep it really simple, and it's gonna help you boost yourself as well. One more thing is who's on your team? Who are the founders, co-founders? Are you guys full-time or part-time? Do you have technical co-founders or not? If it's a tech startup, obviously you would expect to have technical co-founders, and that's the norm. And what do you want? If you want an investor to invest, ask. If you have a question, ask. In one of our previous lectures, we mentioned that if you go ask for money to someone, you would get nothing. But if you go ask for advice, you might get money. So this is how it works. But when you're officially going into the fundraising round, obviously you should have a goal of this is how much money we need to raise. No, why you guys? No, what's your unique insight? And it can be something only you know. Unique insight that without complex language. Unique insight can create the aha moment when you can show it to the investors. They'll be like, oh yeah. And maybe no one else in this world can do that better than you can. What's your progress so far? Why now? How fast you guys produce work, the return on investment that the investors can have, and the first is your product development and customer, and then the fundraising or business development deals, a bunch of this stuff. Now comes quantity. So how much you need to raise? Usually, typically, it's the money needed for the next 18 months in a lean way possible for your startups to survive. And usually you would probably give 5 to 20% of the company's equity, but don't exceed 30% at most. I mean, it's still theoretically we say 30%, but try to keep it under 15, 20%, or if you can keep under 10%, that's even better. Then there's like timing. Start the process in advance. 18 months is the shortest acceptable operational runway. You'll have to keep in mind what I'm gonna do for the next 2 years, 3 years. But this is the time that you can keep in mind and then start the process based on that. The timing is all about surviving. It's like you are trying to survive in this stage. You are going for the product market fit, and then once you reach that stage, then you go raise more funds, and then this runaway can come to your company at any point, even if you after you have raised Series A, if you don't have consistent paying customers. Once you have consistent paying customers and acquiring new ones, then you can uh, think about like, okay, we are in a good stage. We can, bring in more employees, bring in more innovations, spend some money in research and stuff. But before that, you'll have to move very, very fast. And fundraising should be done in a good situation, not when you really need money. When you go to investors and you seem like really needy, that's when you get that's when you get fucked off, to be honest. Uh, so other part is about removing significant barriers. So substantial obstacles in the equity structure is founders relationship breakdown, founders severe emotional instability, um, company or founders involvement in severe legal disputes, significant debt. That's why I said don't get into debt or an early stage, because when you go through due diligence, that might play a role as a barrier for investors. And also fraud or lack of transparency. Try to be honest when you're applying to get funds. Be as honest as possible. Uh, Honesty might delay you raising the funds, but it's still always the best possible way. And there's the characteristics of Chinese fund that I can just go over really quickly, which is like there are a lot of B2B or B2C restrictions, different stage. It has restrictions, industry restrictions, currency, localization requirements. A lot of the things comes into play, and also there's like language barrier. If you're not a Chinese person, it can be hard for you. But if you are, yeah, I think it's going to be a good place for you to do startup as well. Okay. Now, what's next? All right. You know everything. You have prepared for your fundraising as well. The next is pitch. Now, what to pitch, right? You have your startup, so you'll be pitching your startup, right? So, first of all, you structure your business plan. No. What's your company purpose? Start from here. Define your company in a single declarative sentence. This is harder than it looks. It's easy to get caught up listing features instead of communicating your mission. Like, for example, the Comash, its mission is to change every single economies of this world. Or in simple term, you can say it's like the operating system of launching startups, which is really clear. Like, okay, this is the system that can help people to launch startups, right? I can use a bunch of these things. It's like a AI engine that matches with co-founders. It has AI with AI agents. You can complete multiple tasks with machine learning, with agentic, machine learning algorithm, deep learning, blah, blah, blah. Like, you don't need that. Just simply say what people can understand. Even if the person in front of you like really tech savvy, explain it really simply, then they will have a better chance at understanding your mission and your purpose. The problem, describe the pain of your customer. Like, why are you building it? How is this addressed today? And what are the shortcomings to the current solutions that you are trying to solve? And then solution. Explain your eureka moment. Why is your value proposition unique and compelling? Why will it endure a lot of hardships and stuff? And where does it go from here? What's the next 10 years looks like for you? And why now? The best companies almost always have a clear why now. Nature hates a vacuum. So why hasn't your solution been built before now? I think you're gonna get asked this question again, like, why you guys are the right person, more than that, why now, why not 2 years ago or something like that. So you'll have to have a solid answer for that. Then market potential. Identify your customer and your share and your market, and then some of the best companies invent their own markets. If you don't find a market, you will create the market. Then there's the competition alternatives, like who are your direct customers? Oh, sorry, who are your direct competitors or indirect competitors? Show that you have a plan to win and crush those competition. This business model, how do you intend to thrive? How are you gonna survive and earn money? Team, like tell the story of your founders and key team members. Financials, if you have any, please include, and vision. If all goes well, what will you have built in 5 years? Now, how to pitch. It's really important. I think there's also a really good video in YouTube from Michael Seibel from YC. He also talked about how to pitch. It's a really good video. I recommend that. You can just search how to pitch Michael's, then I think you'll find it. But I'm going to give you some quick overview. For effective pitching, you need to care about what investors truly care. Your team, why you? I have said that a couple of times already. Your team members' personal backgrounds and responsibilities, the original intention of your startup, unique insights, like why are you guys together, like genetic matching, strengths and weaknesses, and your product, what you do, your problem and unique solution. Startups with the potential for 100 to 1,000 fold return on investment is like the ideal, that the problem you're solving an investor, it catches the investor's attention. How to convince them? A compelling vision plus an in-depth understanding of the market plus a clear path for rapid growth, a clear grasp of the company or product, business key metrics. For example, customer acquisition cost, growth rate, what are these things in your startup, and an explanation of how these metrics will evolve. And also a clear understanding of the total addressable market supported by data and research. Don't just find a number from ChatGPT and just put it there, okay, this is our time. No, have a validated data and research and cite that source. Now, storytelling in pitches is really, really important. How you convey your message to the investors, to your audience. It's really important. Now, I can give this lecture like this. The clarity of thought leads to clarity of speech. Sell yourself, tell insightful stories, catch the eye, builds trust. It's like I'm reading a passage or something. You have to show them why this thing matters to you. And it's like unfolding bit by bit and taking them through the journey of that. When I pitch about co-match, it's like, imagine you are a high school grad, you were fresh in college, or let's say you're in workspace, but you don't feel like working. You want to start something of your own, but you haven't found anyone to start it with because maybe you're that introverted guy. You like to build, but you don't like to socialize that much. You want someone who have similar characteristics of you, but you can go up to people and try to socialize with them by yourself. That's where Homas comes in. Just go to the platform, include all the things, your traits, what you like, what you don't like, and all this stuff, and also include what are the things that you are looking for in your partner in terms of skills, in terms of personalities, in terms of like work ethic. And you can also list your ideas, or you can just try to join another startup if you feel like you want to work with a startup or build a startup together. Then you match, you meet with that person in a cafe, in a cafe or somewhere nearby, or if you prefer working remotely, and then you get down to building. You come back to the platform, you see all the tools right there. There are like personal AI bots that gives you a checklist based on your idea you have. What are the things that you need to do step by step? You're going to build the app. What are the things you need? What are the tech stack? And if you have two co-founders, three co-founders, what is going to be how the cliff mechanism is going to work, how the equity is going to be split. All the things are there. You don't have to go through thousands of videos to find this information. You don't have to go through my 2-3 hour lectures to learn all of this stuff. You already have that. And though those AI, those tools will suggest you can watch this video, that video. Imagine how wonderful it would be. Starting a startup won't be any hard anymore, because now in this world there are a lot of people with amazing skills, but just because they don't have the skills of starting a startup, they don't know where to go from where to where, they're not being able to do that. And that's where we are coming in, and this is gonna revolutionize not only the whole startup industry. We'll be able to see more and more startups coming out from countries that we've never seen before, and it's gonna grow their economies and eventually make this world a better place. See, I'm just telling a story. Maybe I took some time, sometimes I exaggerated, but I just made the story right now. I haven't practiced it before. And so if you can show your emotions, if you can take them through this journey of like how these things work step by step, then they were like, oh yeah, I haven't thought in that way. You could say with so many PowerPoint slides, you could say, okay, this is the data, this is that, this is those, and then market opportunity. But unless you tell a compelling story with those data doesn't matter anything. So keep that thing in mind. So one more thing, as I mentioned, when you are talking about your startup, avoid jargon. Same for delivering the pitch, because it's confusing. Use language that everyone understands. Avoid marketing language. Insight into human nature, know your customer. Like these are the kind of stuff that you need to focus on. Then also you'll have to engage with investors, right? So how do you invest? How do you engage with investors? At first, find your right investors. How to contact investors? You can go to LinkedIn, and I think there are also a lot of other platforms where you might find lots of information about investors. I mean, even though this is not really, there's no really centralized platform as far as I know where you can get access to investors. That's why in co-match in the later stage, we also plan to give the access to startups so that they don't even only stop after launching a startup, but they can also go forward inside the platform to match with these investors. But yeah, then also, but for now, you can go with LinkedIn, you search specific keywords in Google, you ask AI, you can find a lot of different ways. Then you can arrange an investor meeting, send them cold emails, just don't keep it long, just short what you build, who you are, and how you can provide them value. Then have a documentation, follow up with them, and keep constant communication here and there. So finding your right investor is like a long-term goal. It's not gonna happen like, let's say today you do 15 cold reach out and then tomorrow you expect that 15 of them will get back to you. No, even if one or two of them get back to you, keep that relationship moving forward. You can have Excel sheet, make a CSV file, make a list including who has invested in this industry, who has invested in competitors, or how to find them. Go to meetups or try to see where they're going. It's kind of like stalking, but you're not like stalking for harm. You're just trying to get opportunities from them and also give them the opportunity to invest in the next big company. And also leverage your network for introductions. You can ask for your friend who knows another friend who knows an investor or whose father is an investor. Like that's how network works. And as I mentioned, you include platforms like LinkedIn, AngelList, Crunchpage, in China, Chicha and Chi, Mingpian platform. So this is how it works. List of potential investors, email them, cold email them, message them, schedule meetings, disclose price, close them, then revenue. And I think this part I mentioned. One thing is that here is that you can find mentors in the industry, and those mentors can also introduce you to investors. There's one more thing is about financial advisors, but you'll have to keep in mind that financial advisors, most of the time, they have this kind of rule that if they can help you find investors and you raise money, you'll have to give like 3% of the raised money or something like that. So just keep that in check. Like the best way is prompting investors to approach you proactively. And how you do it, at the very beginning, I talked about it. You make a really good product, you build in public, you gather attention towards your startup, you have paying customers, investors are gonna come to you right away. Before investor meeting, research on your investors, budget availability, see if you're going into a market where you don't have expertise and then you're trying to like ask them for investing in a startup, that's not going to work out. Also, if they have the decision-making authority or not, because investor are like different terms. Some of them are like inside of private equity, they don't have the big decision to make. They just search the startups, connect with them, and then just forward them to the main decision maker. But you haven't built any relationship with that main decision maker, so make sure you keep that in mind. Oh my God, I'm so sorry. Last night I didn't sleep a lot. There's a saying, your dreams only let you sleep, unless you fulfill them. So it's like kind of like that. I mean, every day nowadays I've been like thinking about how I make it better. How do I get customers from a startup? How do I, make it launch? No, like, so these are a lot of things. How do I get into OIC? And I built a good team. Yesterday, I got also a good team member who's like into video editing, who will join as the creative director as a team member. But oh my God, what am I sharing? But yeah, this is the thing. This is how obsessed you should be. I'm so obsessed that I probably like slept maybe 2 or 3 hours last night, and since morning, I tried to go back to sleep, but I couldn't. And then I was like, no, I'll have to come back and record this for you guys. So yeah, so just forget my mistakes, and sometimes I'm just No, I'm doing this. So okay, let's go get back to this thing. Um, Keep in mind that the deadlines. Uh, if you are kind of reaching out to investors at the end of the year, like December, when probably like they have invested all of their money, you'll probably not get any chance. Also, try to go like in the middle or even like earlier in the year so that they have enough capital that they can take risk, they can invest, like in the last quarter of the year is kind of like most of the time hard. Also look into their startup, like their investment history, the reputation, track record, and the ways to work with the founders. How do they work with founders? Do they just give the money and then just expect them to like uh, catch up the deadlines, or the mentors them, they give them resources? Just that, those are really important. And if you are applying to VC firm, look at their fund size, um, currency of the fund, background of the limited partners, and fund duration. What is the single investment amount, and which stage they prefer to invest. So if you are in the early stage and if you go to a company that mainly invests in Series A, then you're not going to be able to raise funds there. Whether they lead or follow investments, because a lot of the companies, they prefer to lead because they have a lot of funds and they are kind of reputed, and the others are like ones that kind of like confirmation, like they have this confirmation bias. They don't want to take the risk and lose a lot of money because their fund is limited and then need the best return on investment. And what are their past investment cases? See what are the companies that they have invested in the past, how much of them were successful, how much are not, and if they falls under your industry or not. Synergy with the firm's star projects, as I mentioned, if it's fall under your industry or not. Okay, we just can skip this slide. Yeah, during meeting you can talk about valuation is like because it's commodities, market supply and demand greatly influence valuation. Yeah, so don't shy away from valuing your company for what it is. Don't give a lower valuation just to be able to raise some funds. That can harm you in the long run. Okay. For investor meeting, provide a small valuation discount for the first term sheet. Then rapidly interact with many investors to understand company value. From questions to lead investors into your framework. Mentioning competitive investments first, and it's an effective start to the discussion. Ensure a thorough understanding of your business, especially the numbers. Then, last thing is follow-ups and communications. You'll have to maintain relationships with potential investors. You'll have to keep an honest communication and also keep the engagement ongoing. Then the misleading nature of investor feedback. Investors might mention, it's like polite excuse, which are often not the real reasons. Let's keep in touch. Come back to us when you have a product ready or when you have a lead. They want to be followed. They don't want to lead. Approach us when you have customers. This is like excuses. It means they don't want to invest in you. Just get that straight. Don't think that, oh yeah, I have some investors interested in me. They want to invest, but I think I'm not ready. No, just don't cheat yourself. Go build, and when you have a good product, they're gonna come to you automatically. Or there can be other reasons also, like it's the lack of fundamental conviction, or also it does not align with their investment thesis. Fundraising document, term sheet. I talked about term sheets before. You can go over it again, take a screenshot or something, or do like in-depth research to understanding more about it. Um, So this is the thing that I talked and I said in the very beginning, that when you ask for money, you get nothing, and when you ask for advice, you may get investment. The reason that is the way for them to get to know you are the person who's willing to learn. If you're the only person who's just looking for money, then you're gonna ask money, and that's how they're gonna feel about it. Uh, and you'll have to understand investor expectations, like, so how you can do expand your investor network, provide values, and building trust with investors, and investor expectations and commitments. How do you provide values and build trust with investors? Share space and learning materials, organize joint sports activities, introduce outstanding entrepreneurs and resources. You can regular updates and consistent communication, handling bad news and setbacks. These are gonna catch investors' attentions towards your startup, and most importantly, towards you. Investors are most eager to find founders who are experts in their business field and are among the few who can succeed in it. So you'll have to show them you are one of them. These are some memes. It's like, because now there's like AI boom. So the first one, you can see that non-AI founders trying to talk to VC, but the VCs are kind of turning around, turning around. They don't want to talk because they want someone who's expert. And what is the tech space right now? This is like cutting edge tech GPT. People are saying, oh, it's like cutting edge ChatGPT, but it's like a ChatGPT wrapper. Um, and then the VCs are getting crazy. Like when you say I'm ex OpenAI, Y Combinator, Stanford grad, contrarian VCs, 200 times ARR, founders, college drinking buddy who made it in the cap table. So these are the things that's going on, and because it's like a bubble, AI bubble that's going on. And the other one is like non-AI founders trying to raise capital right now. It's hard. It's hard. If you are not a technical founder, then it's gonna be hard for you to raise funds unless you have a good technical team and you want to build like a technical startup. For me, when I entered university, I wanted to study finance, but in my university, um, there was not really a direct finance major. There was economics, but it was like political economics, which I didn't like. So I switched to computer science, and I'm glad that I switched. It helped me to gain a lot of technical skills, and I feel like I'm learning, even though I'm learning more outside of the class than in class, because I'm doing startup. And when you're doing startup, it's like a real project. And in the class, what you learn is mostly like math-related concepts and theoretical concepts. That can be mostly helpful when you're doing research, but when you're building real projects, you need to learn a lot of things by yourself. That's why you'll see a lot of the times computer science grads, they're like saying, oh, I can't find jobs. Whatever I learned in college is like useless, because they haven't put them things into practice in real life projects. They have never worked in real life projects when they were in college. So that's why I encourage everyone who's in college or high school, try out different projects. Everything is online. You can find everything: Code Academy, Free Code Camp, W3 schools. They have a bunch of free stuff. Learn from there. Yeah, even Harvard puts their CS50, the most popular course, online for free. Just go and learn from there. Start step by step. Start with Scratch programming language, and then move forward. There's a big thing going on in the industry since like Jensen Huang said, oh, English is going to be the next programming language. People think that you don't need to learn programming language. No, it's not that you're learning to code. You're learning the logic behind it. You're learning how to work with this kind of technologies. How do you match these things? How do you integrate your code bases into the front end system, into the back end system, and how does this sync with each other? You can't learn these things just by vibe coding. Just don't be a vibe coder. If you want to build like a billion-dollar company, only vibe coding won't work. You can earn like hundreds of thousands of dollars for a short period of time building like a vibe coding tool, building a tool through vibe coding, but it might not work in the long run. Okay, I'm not going to talk more about building investor relationships because I think all of you know how to do that. And also, so far we've talked about it. And if you want to learn more about it, you can just go through the slides. Hopefully, I'll be able to upload this in my channel, but is that our channel is not that big enough, so YouTube doesn't allow us to include links in the description box yet. But later at one point, if I'll try to put it in the comments, or I'll do it later when I have more subscribers in this channel and people want to get the slides. But you can for now take screenshots, just pause and take screenshots, and or just take notes. That's completely fine. Yes. Now, once you have built the investor relationships, get ready for the next round. Investors are like obligated due to vested interests rather than the legal constraints to assist in securing further funding. And this was a homework for the cohort 2, which is like get to know 3 founders who have successfully raised funds, interview them on how they found their investors, find 3 venture capitalists or angel investors, and initiate preliminary discussions. And the reading assignment was venture deals. So if you are at home and you're following our lectures from very beginning, please do that as well. This homework is not only for the cohort, but if you're a self-learner, teaching yourself about entrepreneurship and starting a startup, go do this thing. It's gonna help you a lot. Okay, this was it for today's lecture, and I hope you got some value from it. And a lot of the times, today I probably shared about some things about co-match. I think it's because we are very close to launch and we're very confident with the product that we have built so far. We're building. Yeah, you can also check it out going to comatch.ai. I really, really want to change this startup industry for good. All of the motivation why I'm doing all of these things, like teaching here without charging anything, making this content free, arranging cohort, uh, building channels, trying to do content besides studies, is that I want more and more people to learn about startups, to do startups. Because only through startups you can change the world. And there are a lot of other ways, but at the core of everything comes innovation. Even if you look at US economy, like OpenAI, Google, Microsoft, Apple, Oracle, Palantir, PayPal, Stripe, like Nvidia, these are big companies who are at the backbone of US economy. Imagine if tomorrow this company shuts down, this will crash. So those mom and pop store businesses, those doesn't work anymore. I mean, you need small and medium-sized businesses for uh, people to do some of the daily activities. But if you don't have the core, which is this technology that helps these small and medium-sized businesses to run, like this internet, the servers, the infrastructure, if it dies, the small and medium-sized businesses will also die. That's why I want this world to get better. I come from Bangladesh and I have seen that how much potential the country has, but it's just because of the lack of resources, people doesn't know how to start a startup. They don't have that enough resources. So I want to make it easier, not only for my country, but also countries around the world and founders from there. I want to see more and more founders, diverse group of founders from diverse countries, not only from US, China, Europe, but South America, Latin America, South Asia, um, Middle East, like from everywhere. I want to see more and more founders because Everyone has brain, everyone has that intelligence. It's just the resource, just the way how you find a co-founder, how do you start a startup, what are the steps that you do. And sometimes the language is a barrier for everyone. I also make it vanish away for every country. So that's the goal, and I want you guys to also do something that you love, that makes you feel passionate every single day. Whatever industry you are in, it doesn't have to be that big of an idea. You start with very simple idea. I started with simple idea, like I wanted to match co-founders because I saw at first in cohort one that some of our students are having problems with finding co-founders. We have tried a lot of different activities. Every week or every other week we had this special activity, in-person activity, but still it didn't work out. And one or two of them chose a co-founder, but later they also part ways. So I would say keep faith in me, keep faith in yourself, and keep doing innovations, keep learning. And I will see you on our next lecture, which is lecture 6. Till then, have a good day, have good learning, and see you soon. Bye bye.